What if I told you that a $5,000 credit card balance, paid only at the minimum, can take longer to pay off than most people's mortgage? Not because you did anything wrong, not because $5,000 is an unmanageable amount of debt, because the minimum payment was never designed to pay off your balance. It was designed to keep you paying on it for as long as legally possible. Let's do the actual math. My name is Joey, and on this channel, I want to teach you how to save, invest, use, and grow your money so you can have more freedom and retire earlier without depending on the government. Subscribe to the channel and like this video. Here's the scenario. A $5,000 balance at 23% APR, a fairly typical credit card rate. Your minimum payment is usually calculated as around 1% of the balance plus that month's interest, which comes out to roughly $146 for the first payment. Now look at where that $146 actually goes. About $96 of it covers interest. Only about $50 actually reduces what you owe. You're paying almost twice as much to the bank for the privilege of carrying the balance as you are toward the balance itself. Here's what that does over time. Paying only the minimum on $5,000 at 23% APR takes over 23 years to pay off completely. Total interest paid over those 23 years, approximately $8,900 on a $5,000 purchase. You end up paying close to $13,900 total for something that cost $5,000, and it takes nearly a quarter of a century to finish. This isn't a rare edge case. Tens of millions of Americans carry a balance and make only the minimum payment every single month, according to the Consumer Financial Protection Bureau. Most without ever calculating what it's actually costing them, because the statement never shows you the 23-year version. It just shows you this month's number, small enough to feel manageable every single time. Now, here's the same $5,000 with one change. Instead of the minimum, you pay a fixed $250 a month. Same balance, same 23% rate, payoff time about 2 years and 2 months. Total interest paid, approximately $1,365, not $8,900. Same debt, same rate, 21 fewer years, and about $7,500 less in interest.
Federal law actually requires your statement to show a version of this comparison, a small box listing how long you'd take to pay off the balance at the minimum versus a fixed higher payment. Almost nobody reads it because it's printed in the same small, unremarkable font as everything else the bank doesn't want you to look at too closely. Start by finding your actual numbers. Log in and check your current balance and APR directly, not from memory. Calculate 1 to 2% of your balance to see roughly what your minimum is actually covering, and notice how little of it is principal. Then pick a fixed payment you can sustain every month above the minimum, and automate it the same way you'd automate a bill, not something you decide fresh each cycle. Even an extra $50 to $100 a month above the minimum meaningfully cuts both the timeline and the total interest, long before you get anywhere near $250. If you're carrying balances on more than one card, pay the minimums on all of them. Then send every extra dollar at the card with the highest interest rate first. That's the debt avalanche method, and it minimizes total interest mathematically. And while you're paying it down, pause new charges on that card entirely. Progress made in month 1 shouldn't get undone in month 2. $146 a month feels manageable. 23 years and $8,900 in interest is not manageable. It's just invisible until you calculate it. Subscribe for more math-based breakdowns of the debt and money decisions that don't show their real cost up front. Next video, the full debt snowball versus avalanche breakdown, if you're carrying more than one balance right now.